we're not going to bottom with an 18 forward multiple. And typically, when the stock market bottoms in a fundamental bear market, it gets stupid cheap. And it gets so stupid cheap that you want to jump in with both feet because the expected returns going forward are so lucrative. And traditionally, the bottom or the trough in the multiple is more like 12 to 14. When you go back to the Paul Volcker low, people say, well, what was the Paul Volcker put? Everybody's asking about the Powell put. Well, the Paul Volcker put in the summer of 1982 was 8. And that was a touching off point if you had the liquidity in cash and if you weren't chasing and losing money on every one of these bear market rallies. We had almost a 2-decade long secular bull market that came actually off a stupid cheap stock market. Is the stock market stupid cheap at an 18 multiple? The answer is no, it's not. It's still very expensive. And when we get closer to 12 or 14, I'm going to get a lot more excited. The other thing that I tend to look at is the equity risk premium, which compares, the earnings yield to the underlying treasury yield. And it's right now, call it 200 basis points. But you see at the lows, with a very tight standard deviation, the ERP as it's called, is more like 425 basis points. I mean, we're not even halfway there yet, is what I'm trying to say. We're not even halfway there. And then it's something that you and I talked about off camera, which is what I've been saying. And of course, you have to have the view that we're going to recession. So look, if you're in the soft landing camp, if that's your view, and this is always a case where your assumptions will drive your conclusions. If you believe we're going to avert a recession, you want to buy the stock market. You want to buy the stock market. But you see, I think that the odds are overwhelmingly in favor of a recession in 2023. And if that's the case, then it's a matter of timing, not just magnitude. And traditionally, the market bottoms 70% of the way into the recession. In a recession bear market, not a correction, this doesn't look like a correction to me, but in a recession bear market, just as the market peaks ahead of the recession, the market bottoms ahead of the recovery. The stock market's leading indicator. And normally you're in the 7th inning of the recession by the time it sees the whites of the eyes of the recovery. Well, that recovery is probably not going to come until end 2023, 2024. So we talk about a market bottom when the recession is only now starting or is about to start. It's just way too early from a timing perspective. No one's going to ring the alarm bell at the lows to the day or the week. But if we're taking a look at the balance of risks, if you have a recession view, which I do, the market bottoms 70% of the way through, again with very little deviation from the norm in that regard. And then we have to basically take a look at the Fed. It's very interesting about the questions I get about whether or not we bottomed. I find it, and it's just basically, I think, a commentary on human nature, that when the Fed is easing, let's take a look at 2020 post-March, 2021, or you can take a look at other cycles. When the Fed is easing or is accommodative, then it's always don't fight the Fed. Don't fight the Fed. No matter how bad the economy is, don't fight the Fed. We had a very weak economy heading into 2019. Remember, the Fed's last rate hike was December of 2018, and the economy wasn't doing so well at all. Don't fight the Fed. 2019 turned out to be a phenomenal year for the stock market, even with an economy that actually wasn't doing so well. This is, of course, all pre-COVID. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. Even when it seemed like we still had the Black Plague in our hands, when we still didn't even understand the nature of this pandemic. The Fed cuts rates to zero, radically expands its balance sheet, and the stock market was surging and continued to surge. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. So what I find interesting is that I get lots of questions about, have we hit bottom yet? Have we hit bottom yet? Have we hit bottom yet? Nobody says to me about fighting the Fed anymore, because it seems in this industry, and let's face it, I've been doing this for almost 40 years, this industry is populated and dominated by bulls, by optimists. And I don't think there's anything wrong with that. We should always be optimistic, but we should also be realistic. But I just asked the question, and it sounds rhetorical, what happens to don't fight the Fed when the Fed is tightening into the most inverted yield curve since April 1981. That was the last time the Fed was raising interest rates, let alone the balance sheet. The last time the Fed was raising interest rates into a 2s-10s yield curve of minus 80 basis points was in April of 1981. And then a recession, a double dip, was staring us in the face. So to be commenting on the prospect of a stock market bottom, a real fundamental bottom, as the Fed is still raising rates into an inverted yield curve, to me is the nuttiest proposition I've ever heard, but it's a proposition I get all the time. Basically, here's what happens at the lows. I said before, we're 70% of the way into the economic downturn. The market is looking at the clouds parting at the lows. And the Fed is 70% of the way into the easing cycle. Well, Michael, there's still tightening policy into an inverted yield curve. And we're talking about a market bottom. There's no evidence ever of the stock market bottoming, especially in a recession, with the Fed tightening policy into an inverted yield curve. At the lows, the Fed has been cutting interest rates, and cutting interest rates so forcefully that the 2s-10s curve, which I just said before is about minus 80 basis points right now, is plus 140 basis points. I mentioned about the multiple before, what that looks like at the lows. I mentioned the equity risk premium, what that looks like at the lows. But I'd say that the most important variable is the shape of the yield curve. And the Fed has to cut interest rates enough that the front end rallies sufficiently to cause a pivot in the yield curve to a positive slope. And normally it's 140 basis points when we finally get to those lows in the stock market. And those lows in the stock market will come, but it's not staring us in the face. It's at best the second half of 2023 story. The thing about interest rates, which Albert Einstein, who might have been a physicist and won a Nobel was a Nobel laureate in that regard, was actually one of my favorite economists, because he famously said that the power of interest rates is the eighth wonder of the world. But you see, because the economy, most parts of the economy reset into higher interest rates with a lag, tends to take time before things start to break, as you just said. And things start to break when cash flows start to contract, which hasn't happened yet.
Right.
So it's like, it's like telling me, that, the Fed is raising rates pretty aggressively in 1988, 89. And Greenspan took over. This is after the stock market crashed. They over-eased and then they over-tightened. They inverted the yield curve. Not as inverted as it is today. And Michael, you and I would have the same conversation. What's breaking? And then by 1990, things were breaking pretty hard, like the entire savings and loan industry. And then we had to create RTC. And so we'd be having this conversation in 1988, 89, and you'd be saying, where's the beef? Well, the beef came, but it came with a lag. It's no different than when the Fed was raising rates in 1999 and into 2000. And once again inverted the yield curve, which everybody ignored. But the most pernicious impacts of the tech wreck and the impact it had on capital markets and the economy happened in 2001 and into 2002. So we weren't talking about WorldCom or Enron or about technology detonation until actually after the Fed was finished tightening policy. All the bad stuff tends to happen, you see, with lags and after the Fed's already done. For all the people that say, I can't wait for the pause. Yeah, be careful what you wish for.
Yeah.
Back when I was at Mother Merrill, you think about it, the Fed was done tightening in the spring/summer of 2006 after Bernanke took over from Greenspan. So once again, you'd be saying to me, nothing's going on. Nothing's going on. Yeah, but we all know in 2007 and 08 a lot went on. And so I would just say to you that there's a lot of stuff that's going to happen that hasn't happened yet. There's extreme leverage in key corners of the capital markets globally.